how should one read into last night's reversal in the dollar index and the sharp comeback in US equities? Gautam Shah joins us now, and we'll spend some time with him looking at understanding the big picture, trying to understand that what are the charts in a sense indicating for long to medium term trends. Gautam, fantastic to have you back. Thank you for joining us. How should one read into last night's comeback in US market and the drop in the dollar index?
Good morning, Nikunj. I think it's just normal and it's very temporary because I think the US markets just completed a cycle on the downside. All along we were working with the June lows. So if you look at the S&P 500, 3600 to 3650 was a very obvious support level, which I'm sure every market participant in the world might have been watching. And that's really triggered the bounce. Excuses come out of nowhere. I think it was just a support and therefore a bounce had to happen. And the markets were very, very oversold on the short-term time frame. But the problem is, this looks temporary and the markets, equity markets in general, continue to look quite fragile. In fact, what is discouraging and even scary is that 80% of the world equity markets are still in the bear market that started in October 21. And now we are at the doors of October 22. So it's been one full year and the markets have been making a series of lower tops and lower bottoms. But in that context, if you look at India, we are clearly better off. We haven't done so badly. We have been in large ranges. I think 15,500 on the downside, 18,500 on the upside. And I think this is just quality consolidation and outperformance. So the world and the US continues to be in a difficult space. I see this sell-off. I see this rebound getting sold into, and I think eventually we will go on and make new lows. If that were to happen, India, will see further pain in the near term.
So what you're making a case, Gautam, is that we should not get excited about the decline in dollar index. The trend is still strong. What we have seen is more like a blip in the long-term trend.
Yeah, I think so. I think what I'm actually looking at is the USD INR, because if you look at the last 6 months, there has been a near perfect correlation. So whenever the rupee has appreciated, Indian markets have done well. And whenever the rupee has started to depreciate, we've just fallen off the cliff. And this has happened multiple times. Even in the last 7 to 10 days, the manner in which USD INR got past 80, I think that pretty much triggered this 1,000-point correction. It's just a correlation that has worked. It's not something that's going to work forever. But in the last 3-6 months, given the dynamics, around the world currently, it's working quite well. So even looking at the currency space, the dollar index, the US 10-year, the Indian 10-year, all of these factors suggest that we are not out of the woods as yet.
Don't get this one wrong, Gautam. In the morning we were debating, and we were debating last evening also, that do we have a temporary bottom in place for US markets and do we have a top in place for the dollar index? Your view is that in the medium term, barring 1 day, 2 day, the trend for the dollar index is higher and the trend for the US market is lower.
Yes, that's exactly the view. I think, you need to understand that India VIX is still at levels of 21, 22. When in the past have you seen markets bottom out with such low levels of VIX? So I think it's the activity is just started off in the last 1 week. And even if you look at the US market VIX, it's really not, gone off the roof. So there are signals that we will see lows once 3,600 breaks on a closing basis on the S&P 500. In fact, if you ask me what my worst case is, it's quite scary because that's at 3250 on the S&P and significantly lower for the Dow as well, maybe about 7 to 8%. So in that kind of an environment, I think bounces will not sustain and it will get sold into.
Sure. Gautam, that brings me now to Nifty. We breached the 200 DMA today as well. While we've started off in the green, it's a bit of a struggle only. Expiry day today. What levels are you monitoring for the index? Where do you see the supports? Where do you see the resistances?
Aisha, I think since the time we started to correct from 18,000, we were very clear that somewhere around 16,800, the market should find quality support. Why? Because that's where the 200-day exponential moving average was. And it was also an important retracement number. If you look at the last 3 months, there were important pivot points around the 16,800 area. And therefore, the bulls are trying to put up a fight. But the problem is the market is so fragile and the sentiment is again got so weak. And the studies don't have indications of bottoming out. I think rallies will get sold into. So once we break 16,800, I think there is a fair chance that we move towards 16,300 to 16,500, where another attempt to bottom out would be seen. But again, look at it in the bigger context, in the context of the ratio charts, which is Nifty divided by S&P or Nifty divided by the world. We are still way, way better because while most markets in the world have broken June lows, we are still good 10-12% away. So there will be outperformance, but along with pain.
You know, Gautam, the chartists that we've been interacting with on a daily basis, they also made the observation that more than the index, the problematic chart is of the Nifty Bank because that is looking like the weakest link in the entire pie. What do you have to say about that? And also this tactical shift that one is seeing out of ICICI Bank into names like an Indocent.
See, I think let's not forget the Bank Nifty witnessed a spectacular rally in the last 2.5 months. You know, a 32,500 became 41,800 in a matter of 2.5 months. So that was a massive rally any which way without any meaningful correction in between. So I think the upcycle had got completed. From there, a cool-off was required, which is what is taking place. And yes, you know, with the banks now correcting, the market is looking very different. You know, the texture of the market is very different. And I think the Bank Nifty is likely to move into the 36,500, 37,000 band. The problem is some of the star performers, ICICI and SBI, had run up so much, you know, that they just got over-owned. And that's probably the reason they are going to see some cool-off. And the non-performers are anyway not doing well. I mean, the HDFCs and the Kotaks of the world. So it's not a good place. And the bigger point is that there is no leadership. You know, if you look at the three big pockets, which is IT, banks, and Reliance, I think 3 out of 3 have a negative setup at this point. In fact, we are quite bearish on Reliance, and we feel it is one stock that is going to take this market down, even though IT is trying to make a bit of a comeback. So I think you have to be very stock specific, and the opportunities on the long side are really in the mid caps and small caps, and not in the index and not in the large caps.
Thanks, Reliance. You're seeing downside for all three of those heavyweights. So when you say mid caps, would you like to be a little bit more specific by way of individual stocks or maybe pockets that you believe that could see a move on the upside? Would it be, say, sectors like defense, etc.? Is that on the radar?
Well, see, the first thing is when a storm is passing, there's no point standing in between and being brave. You know, a lot of people tried to do that in the last 10 to 12 days. But whatever the fundamentals are, it didn't matter. Stocks have corrected very big, and I think it can get, uglier. But having said that, I think there are a lot of pockets in the mid-cap space, like auto ancillary, mid-cap cement, some of the power names, some of the infra names, which I think have the potential to do well over a 6 to 12-month time frame. So if your vision is 1 to 2 months, there is a problem. You know, I don't think it's going to get over in a hurry. But if your vision is 1 year, I think even mid-cap IT for that matter, I think the way mid-cap IT has stabilized in the last 7 to 10 days is quite encouraging. In fact, even pharma, you know, pharma hasn't participated on the downside in the last 10 days. So we are seeing some green shoots on the charts that should lead to strength. So these 4-5 pockets that I mentioned, along with the unlock trade and the real estate space, you know, we like all of them long term. The problem is short term.
Emergence of 2 new sectors, and I really want you to sort of validate if at all there is merit in looking at them. We've seen FMCG see a solid turnaround, largely because of the softening in commodities, and pharma is attempting a comeback. Meaningful, you think?
Well, FMCG we continue to like. I think the beauty is it's just led by ITC, which is in a league in itself at this point, and I think it's going to do bigger things going forward. And given the kind of weightage it has on the index, I think it will keep the FMCG index steady. So we actually like both ITC and HUL. The problem is, aside of these two, you don't have many good charts. So the index is going to be protected because of these two names, but nothing else looks very, very interesting. On the other hand, pharma has been an underperformer for a year and a half now. But the kind of relative strength it's seen in the recent past tells me that maybe, you know, you've reached that value zone and a place where the risk reward is not too bad. But still, I don't want to be a contrarian investor here. I want to chase momentum. Stocks like Cipla, Sun Pharma, are the ones which are standing out, maybe even a Loris Labs. So I would, you know, take very small bets there and gradually as there is follow-up, maybe then top up on bigger quantities.
Gautam, so what should be, see, one is a 3-week strategy and one is a 6 to 12 month strategy. In the 3-week strategy, the downtrend is pronounced and we are in a short-term downtrend. But in the medium term, do you think traders will make more money by going short, or they need to do the reverse, which is buy the dip?
Yeah, that's a very valid question, Nikunj, because I think what you need to understand right now is, do you buy the dips or you sell the rally? I think it all ends up, being this question being answered. I still feel that from a medium-term perspective, you buy the dips. Short-term, you sell the rallies because, it's a trader's market, VIX is heightened, global markets are in a difficult space. But I think anything around 16,000 to 16,500, I think our markets will look attractive on the charts. Because I think we are showing outperformance, as I said, versus the rest of the world. And I'm not of the view that we will go on and make new lows, which I think some people are trying to highlight. I think India will stand out. And the moment global markets stabilize, hopefully over the next 2 to 3 months, I think India will be back.
To ask you two direct questions and maybe archive them also. On a scale of 1 to 10, in next 6 months, what are the chances that Indian markets will make a new high?
Okay, 6 months? Well, I would give it a 4.
Okay. On a scale of 1 to 10, what are the chances next 6 months Indian markets could make a new low?
I would give it a 3.
So then what will markets do if they will not make a high and a low? Stay in a range?
Yeah, absolutely. I mean, let's not forget we had a wonderful rally for 2 years, yeah, from 7,500 to 18.5. So if we do nothing for a year, 15 months, and just consolidate in a band while stocks do well, it's a stock specific bull market. It's not an index large cap driven bull market. So I think it's quite harmless, and I think it's a good place to be in. We are all become very obsessed to seeing indices make new lows or new highs. I think it's about time that we get bottom up about the entire approach.
Yeah, why not consolidate a little bit? But in this ranged consolidation phase also, Gautam, I'm sure you've marked your upper end and lower end of the range, haven't you?
Yes, I have. And I think it's very clear. I think 16.5 and 17.5 is now the tighter range that we are working with. If you look at the last 12 months, it's pretty much been 15.5 and 18, but that's a useless range to work with for traders and investors. So I would say 16.5, 17.5 in a normal scenario is my working range. But once again, my concern is the US. It's not looking good on the charts. And if the S&P 500 does go down to our worst case of 30 to 50, then at some point of time, even 16.5 will break. And I think we'll take it one step at a time.
Okay, sure enough. Great to have you on the show, Gautam. Thank you so much for taking the time out.